that MAP changes and recent NFIP changes have on flood insurance. Our presenter is Bruce Bender, who many of you may know. For those who don't know Bruce, he's an outreach and insurance specialist with over 30 years of experience. He has been providing community engagement, outreach, and training/facilitation services and acting as a flood insurance specialist since 2002. And he has supported Georgia DNR mapping efforts as a consultant to the Dewberry-Atkins team for the past 10 years. Previous to that, he managed one of the largest Write Your Own programs and managed an insurance agency. And with that introduction, I'll now turn it over to Bruce.
Great, thanks, Emily. Just a quick sound check. You can still hear me okay?
Yes.
Perfect. All right. Well, thanks again very much. Now, I don't profess to know everything about the flood insurance program. Those that know it know it's very complicated. And if there's something I don't know, I will find out, and we will include it in the email that we send out the presentation after this presentation today. So let's go ahead and get started. Today, basically 3 areas we're going to cover for you. First, there was going to be talking about the effects of MAP changes on flood insurance. But then I shouldn't say a lot, but people do confuse changes with the NFIP that affect their premium. They sometimes confuse that with changes that are going on with MAP. So we're going to talk about recent changes to the NFIP as well, and then finish up with some resources and tools. And that one section we'll go by real quickly because all the URLs and stuff you don't need to be taking down. Also, FEMA.gov changed a lot of them around, so we've got links to the new ones on there for you. As Emily pointed out, we will be sending a copy of this presentation to you after the presentation today. And CEC certificates will be sent out separately. And but as Emily mentioned, you'll have to answer poll questions and give us some details at the end. Speaking of poll questions, we have one here, and I'm going to, since I'm driving this, I also get to put down the poll question or pull up the poll questions. So let's see if this works. Hopefully on your screen, you'll see, do you live in a flood zone? Question, yes, no, or unsure. So I'll give a little time for people to answer. This helps practice with the chat function because we've got a more difficult question later on here. I'm seeing the questions kind of coming to an end, so let me close out the poll. A couple more here. And let me go ahead and show the results here. Hopefully you'll see that some of you didn't answer, but as mentioned, we need you to answer these if you want CE credits. And it looks about half of you said, yes, you're in a flood zone, and about half of you said, no. And in the reality, and many of you heard me have asked this question before in the past, we all live in a flood zone, right? It's not whether you're in or out, it's the level of risk. So we have the high risk flood zone, zone A and B. We have the moderate B on the old map, shaded X on the new maps, and X or C on the old maps. So we all live in a flood zone. It's the level of risk. And it's important that we carry this message forward, that when you're talking to your residents and business owners, when they come to these map change meetings or just talking to you about a flood map or their flood risk, that you tell them that, hey, you are at risk. You didn't suddenly become at risk when this new map came out. It's just we identified the risk was higher, or they may no longer be at risk or never were at that. I shouldn't say no longer at risk, but we're no longer at a high risk, and but they're still at risk. It's just the risk is less. So that's kind of some of what we're going to be talking about here. Sorry, we've got some technical things here. So let's move on to the next slide. As I mentioned, the first section here, we're going to talk about the effects of MAP changes on flood insurance. But before that, a couple things I want to make sure we're all on the same page about, and that is the effective dates. the 30 days. So we're all pretty familiar with the 30 days. And with that, as you know, typically there's a waiting period. They don't want people rushing out when they see the water about to go over the banks. But there's also the 0-day waiting period, and that is when there's a lender involved. And if a lender requires it, there is no waiting period. But one that a lot of people don't realize is there's a 1-day waiting period. And that is if when a MAP becomes effective and you're now identified to be in a high-risk area for the first time, that there is only a 1-day waiting period if you don't have a loan. Now, if you had a loan, it would be 0. But if you don't have a loan, you don't have to wait the 30 days. It's only a 1-day waiting period. And what's unique about this um, option is that it lasts for 13 months. So the effective time or period that you have a 1-day waiting period is 13 months after the effective date. 1-day waiting period. So keep that in mind for people newly identified in a high-risk area and do not have a loan for that lender requirement. A couple other things, make sure we're on the same page. Preferred rates versus standard rates. Hopefully we're familiar with this, but again, a preferred risk rate, preferred risk policy are for those in the moderate to low risk areas, B, C, and X zones. Limited loss history, $1,000 or less to most you're allowed to have. A few years ago, they added AR and A99, but I don't know if we have those in Georgia. What's great about this is that it's an easy policy to write. In fact, in the NFIP, almost half of the policies in the entire U.S. are in Zone X. It's fixed premiums. It's easy for the agent to write. You get a choice of different limits and premiums attached with it, and contents is automatically included with the homeowner's PRP. If it doesn't qualify for preferred risk rates, we have standard, what are known as standard rates. These are just like if you have auto insurance and you're newly married and your wife or your spouse and you don't have any accidents or tickets, you get really cheap auto insurance. But as soon as you have kids and they turn 16, then suddenly, boom, it goes up. And that is because the auto industry knows that these kids are going to come home and say, hey, that radar gun was wrong. I wasn't going that fast. And yes, I've had that conversation with my son when he was a teenager about that. They're just a higher risk. And so you no longer get the preferred auto rates, you get more higher standard rates. Likewise, if you're in a high risk area or you've had losses, you don't qualify for that preferred risk, you get standard rates. The limits are a lot more flexible. We use right now rate tables. I'll mention risk rating 2.0. That may all change next year, but right now we use those rate tables on there. But what about those properties that were in a moderate to low risk area and now are identified in the new map to be at high risk? FEMA created this policy or rating option actually called the newly mapped procedure. Now, I don't like the word newly mapped. It sounds, because I've been in these open house meetings where the public comes in and goes, you mapped me in there, you put me in that. Actually, what happened was FEMA or the CTP Georgia or the local community, whoever did the mapping, identified that actually the area around your building, your house, is now at a higher risk than thought previously. And when that happens, we know you as the homeowner or business owner didn't do anything to really change that, so we don't want to penalize you. So FEMA created this rating option called the newly mapped procedure, where you slowly go up in premium until it reaches a standard Zone X rate, or perhaps the new map is cheaper. And you start out at that preferred risk policy. Of course, you have to be eligible for it and then slowly go up. But you have to have that policy in effect within the first 12 months. Finally, one other thing I want to make sure we're on the same page about, and I'll come back to that, by the way, is firm date. This is important, and you'll hear why as we go through this. But just to make sure we're on the same page, firm flood insurance rate map, anything built before the community's first flood insurance rate map is known as pre-firm. There was no floodplain management ordinance to tell them don't build down by the river, or if you do, build to a certain elevation. And so Congress, when they created the program, said, let's not penalize these people. They didn't know better to not build there. So let's discount those rates. Let's subsidize them. Now, they're not subsidized by taxpayers, but they're subsidized by other policyholders. So those in post-firm, which I'll talk about in a minute, or others are paying a little bit more. So these guys are paying, or have been initially paying, up to 50% less than what they really should, what the risk really was. Congress, when they passed the Biggert Waters Bill in 2012 and the Homeowner Flood Insurance Affordability Act in 2014, said, we want to make this a more financial stable program, more solid financially. So we're going to move these pre-firm subsidized rates to a full risk over time. So if the building, though, is built on or after the first flood map, not the current one, then it's known as post-firm. And that's when the community raises its hand, says, I'm joining the NFIP, and I promise to have an ordinance that uses this map as a building guide, as a minimum building guide. We can always require it to be higher. And as you probably know, you require an elevation certificate for rating most of the Zone A and Vs in that area. And in this, it's called a full risk rate or actuarial rate. So those are the terms. So let's jump into the effects of map changes. We have basically 4 I'm going to talk about this morning, or noon, I should say there. Properties that are newly identified to be at high risk, i.e. they went from a Zone X to an AE, or on the coast, it could go Zone X to V. Those that are at a high risk already, but are now even at a higher risk, like A to V zone, or an increase in base flood elevation. But we also have, because of better technology, better modeling, better data, we actually find where the floodplain shrinks, and therefore properties that originally were identified to be at high risk on the older maps now are actually at a moderate or low risk, but not a no risk. Go back to that first poll question I asked you. Do you live in a flood zone? It didn't go to a no flood zone. It went to a moderate or low risk flood zone. But what we find in these map changes, there's a lot of people who are not affected by the map change. But this is a great time as community officials to get the word out to say, hey, but you're still at risk. Check your policy, check your coverage, or do you even have coverage? So I'll talk a little bit about that. Couple rating options that we're talking about, 3 here actually. The first one is called the newly mapped procedure, and I already kind of covered that, but again, to highlight it, you're going to hear these about 2 or 3 times. So they show repetition helps, is if they're newly identified to be at high risk, you can get those preferred risk policy rates for the first 12 months and then slowly go up over time in little stair-step increases. The next is grandfather, and this is where you lock in that lower risk zone, like if you're going Zone A to V, or you lock in that lower risk base flood elevation. There's 2 types of grandfathering. The first is continuous, and community officials on the phone and insurance agents, if there happen to be any, and others, encourage people to purchase the policy before the maps change. That way, then they have coverage when the map change, and they can continue and maintain that coverage. And by doing so, it's very easy then to grandfather using continuous coverage. And as I'll mention again, you can then transfer that policy to a new owner so they can continue to maintain and get that lower risk zone rating. If for some reason you don't get a policy in place, there is another one rating option called grandfathering called built-in compliance. There, though, there's more work involved by the property owner and the agent, where they have to show that the house was built in compliance with the flood map in effect at the time it was constructed. Listen to what I said. Built in compliance with the flood map that was in effect at the time it was constructed. So there has to be a flood map. So this does not apply to pre-firm buildings. So the only grandfathering way that is applicable to pre-firm buildings is continuous coverage. So just keep it simple. Tell everybody to get a policy before the maps change. But as mentioned, there will be times when the maps do change, and what happens is the floodplain shrinks. The person's no longer in a floodplain, and what we want to do is encourage them to convert their policy from a high-risk policy to a preferred risk policy. You as community officials want to make sure they maintain coverage. It makes your community that much more resilient. So when, not if, it floods again, or floods, I hope, first time perhaps for your community, they have coverage and they recover more quickly. So let's jump into the different types. Here we have a nice little red house in zone X, and when the new maps come out, we find that it's in zone AE. So what happens is the mandatory purchase requirement kicks in, and you say you've got to purchase flood insurance if you have a loan. Most lenders are going to require it. Those that are federally regulated, federally insured. So people freak out, they get concerned. The media picks up saying, oh my gosh, the prices are going to go up crazy. And it makes sense because the risk increases, the premiums increases, but that's why FEMA created the newly mapped procedure. It allows you to start, as I mentioned, at the preferred risk policy rates and slowly go up for the first 12 months. Note I put it in red because wink, wink, nod, nod, this may come back in a poll question. An additional 12-month period is there if a lender required. What happened is the Office of the Federal Insurance Advocate kept getting phone calls and inquiries about, hey, my lender found out after that 12-month period that I needed to have flood, or told me I needed to have flood insurance, but I can't use the newly mapped because it says only 12 months. So FEMA listened and they changed the rules. And so after that 12-month period, if a lender comes back and says, you're required because of this map change, we didn't get notice to you in time, you still can use that newly mapped procedure, but only if the lender requested it. But our point, and what Georgia DNR wants to get across to you is, don't wait. If on the preliminary maps you know it's at a high risk, don't wait till the maps become effective. Why? Because you're at risk. Mother Nature's not going to wait. Plus, there's a cost savings potentially. And let me show you that cost savings. Let's say the map becomes effective this November 1st. That means the 12-month period to get to start the newly mapped procedure will end on October 31st the following year. So if you have a policy in effect before, and I picked here, but as you heard me mention a minute ago, don't wait till right here. A new policy effective date is October 28th. Now remember, 30-day waiting period, so you had to have done this in September. It renews during this 12-month period that you have to get a PRP. So you actually start again at a PRP for another 12 months. So you actually don't start the newly mapped procedure till 2022. And then it will slowly go up. Right now, it's going up 15% a year until it reaches the standard zone X rate, which in this case is about $2,200. Now, that'll be going up each year as well. So as you can see, there's a lot of stair steps it's going to go up until it reaches that standard zone X rate. And sometimes you find that because the house is elevated, you may not have to go all the way up the staircase. For example, here we have a house that turns out it's elevated, and if you start at the newly mapped procedure PRP at around $450, it's going to go up the staircase. But then the wise floodplain manager or insurance agent notices, but you're elevated, so let's get an elevation certificate. And they find out that the base flood elevation is 13 feet off the new map, and the lowest floor from the AC says it's 15. And usually at this time, I ask the class, okay, what's the difference? Make sure the coffee's still working and whatever. But you can tell it's a +2. And a +2 is only $880 right now. So instead of going all the way up to that 2,200, you can get off the stairs and be normally rated and get the normal rate increases of 3, 4, 5, 6, 7, 8%, whatever it is that year for zone AE, and not what's been 15%. So two options here on the newly mapped: go all the way to standard zone X, or if you think it's elevated, get an EC and it might get you a cheaper premium. Now we have some talking points. I won't go over detail with them, but it's, again, make sure we're all consistent with our messaging. Things about your buildings now at a higher risk in the area. Lenders will probably be requiring you to get flood insurance, but we have a way to reduce that financial impact, some cost-saving options. Throw some stats out. You're more likely to have a flood than a fire in these high-risk areas. So even if you don't have a mortgage, a loan, doesn't mean you're not at risk. So get that PRP, have it in effect before the maps change to maximize the savings and reduce that risk. So now let's say you're actually in a zone AE and by the coast, and now you find out that the new maps put you at even a higher risk, zone VE, the velocity zone there. Again, the mandatory purchase kicks in. People concerned that, well, it's a higher risk, it's going to cost more money. But that's when that grandfathering that I talked to you about kicks in. You can grandfather in the lower risk zone, that zone AE, instead of zone VE for future rating. Again, you're not locking in the rate, you're locking in the zone for future rating. And as also mentioned, pre-firm buildings, you've got to have that policy in effect before the MAP change to be able to grandfather in at all. The important thing also to remember, as I mentioned earlier, is you can transfer this policy and the newly mapped procedure, this rating option, over to the new owner. Likewise, you may find that the base flood elevation, the height that the floodwaters are going to come, is actually going to be higher according to the new maps. Same concern raised as the other ones. And again, you can use grandfathering to lock in that lower base flood elevation instead of using the higher risk or higher rate of the higher BFE. Again, you're locking in the lower BFE for future rating, not the rate itself. And again, pre-firm buildings, please make sure to have policy. In fact, as I mentioned earlier, from a grandfathering perspective, just have a policy in place if you don't have one already, if you're in a high risk area, and then maintain coverage throughout. Things to say again, now you're at even a higher risk, and so rates are typically higher for those higher risks, but by purchasing a policy before the MAP's revision allows you to lock in. And that word seems to work well, lock, because people can visualize it in their mind of a lock in it. And you lock in the lower risk zone or the BFE, not the rate, for future rating can save on insurance. And make sure to renew it, continuous coverage, throw some statistics out there as well to help back. Don't drive your message with statistics, but it doesn't hurt to have a couple to help show that what the risk really is about. Also mentioned that there are those that are no longer identified to be at high risk. So they were in zone AE and the new maps come out and it shows, hey, the risk has been reduced, but it has not been removed. And as you see the stat there, 35% of floodplains in Georgia occur from policyholders who are in these moderate to low risk areas. Doesn't mean the maps are wrong. It just means that what the government in 1968 asked or designed the flood program to be mapped to, we're actually having more and more floods that are occurring in those moderate low risk areas. So what do we want to do? We want to encourage you to convert the policy to the lower cost preferred risk policy. It keeps your home and contents protected because the risk has not been removed, it has been reduced. If for some reason they do insist on canceling, the refund will be prorated except for the federal policy fee. A lot of paperwork involved, and insurance agents, any of you on the phone, please have them sign a declination form. As one agent called it the I'm stupid form, that why do you want to not have flood insurance? Because it just got cheaper. And that really should be the message. Because look how easy it is for an agent to convert a policy. They'll take that high risk policy and figure out similar rates for calculating out the PRP. You know, are you around that 100,000 building and 40,000 contents, whatever it is, and then rewrite it. That means that if the policy was $2,000 and the PRP is $450, then you're going to get back a difference of what, $1,550 there. So what a great deal. You convert the policy. There's no gaps in coverage. The policy holder gets a refund of that $1,550, and the insurance agents, any on there, you get to keep both commissions. It's a win for everybody, and you as community officials is a great win as well, because they have a policy, and that means they can recover more quickly when it floods. So encourage them to convert the policy. Some insurance companies will automatically, write your own companies will automatically do it when the maps become effective. Others, they wait up to the agent to do, and others do it renewal. And for those that do it renewal, to me, that horse has left the barn, so to speak, and they will have gotten a letter from their lender. They'll be doing the yippee-yi-yay dance and look, we don't have to pay $2,200 anymore. And therefore, let's go spend it on something else. And they've already dropped their policy. So let's try to get them to convert the policy the date of the effective map. Some things to say, and this is the key one. Your risk is reduced, not removed. Goes back to that first poll question. People in moderate and low risk areas in Georgia, over a third of the claims are coming from that area. You probably are eligible for that low cost PRP which gives you contents automatically. So convert it, get some money back, no gap in coverage. It's a win-win-win. Finally, there's going to be situations where there's no change in the BFE. They're still at risk. So it's important they understand what that level of risk is. So first thing is, if you're having the conversation with them, do they have flood insurance? Some may have it. Is it a replacement cost? Because if it's required by the lender, usually they only get what the lender requests. And if, let's say the house is worth $200,000, they only have a $100,000 loan. So it's not insured to at least 80% of the value of the home. You can't get replacement costs. So if they got that 100,000 and the building's worth 200,000, they'll get actual cash value, which is the appreciated cost, and that does not work well for them. They're going to be very disappointed at the time of a claim. And lenders aren't typically requiring contents coverage, so all of their clothes, their appliances, furniture, TVs, stereo systems, hi-fi systems, whatever we call them these days, are lost. And that money's going to have to come out of their pocket. So make sure they're fully covered. And if they don't have it, ask them if they have a PRP, a preferred risk policy. They probably would qualify for one. It's so easy. Have them talk to their agent. You community officials are non-insurance agents, so don't go past that. But agents, any on the phone, have them sign that declination form. So in summary of the changes, if there's an increase in risk, there's money-saving options to help reduce that financial impact. Grandfathering, lock in that lower risk BFE, lock in that lower risk zone. If you're newly identified to be at high risk for the first time, we have that newly mapped procedure. If there's a decrease in risk, if it's going from a V to an A, let's say, rewrite the policy. But if it's going from like a V or A to an X, convert the policy to preferred risk policy, because that risk is reduced. It is not removed. Remember, we don't have the no flood zones being mapped. Finally, no change in risk. Great time to check when map changes are going on. Are they fully covered? And if they don't have coverage, if they're in a moderate low risk area, do you have a PRP? Top 3 questions that typically are asked around map changes are, 1, how am I affected? Then they find out, oh, I'm going to be in a high risk area. The next thing is, okay, Bruce, how do I get in? Then the next is, okay, what's the cheapest cost? I know, Bruce, tell me. So this is where we want you all to be armed, to be ready to review these changes and guide them through these different options. We don't expect or want you to become, though you're welcome to become a flood nerd like me, but don't become experts in this. But know that there are options. Be able to kind of explain, hey, if this is your scenario, boy, there's a money-saving option for you. Call your agent. 3 things please don't say. First is, you don't live in a flood zone, going back to my first poll question. Likewise, then, don't say you're mapped out of or into a flood zone. There always were in a flood zone and always will be in a flood zone. It's that level of risk. And finally, don't say you don't need flood insurance. Do not be a financial advisor if you're a community official or anybody else. Insurance agents recommend them, and if they don't, have them sign that declination form. Let them make that decision that they don't need it. Remember, requirement is totally, by the lenders, is totally different than needing. And sometimes the homeowner or business owner can confuse the two. I threw in some, I'll use a Louisiana term from living there, some lagniappe, some extra stuff in here, because we do have some coastal. And just wanted to highlight, I'm not getting into, because there's a whole workshop you could do, I guess, on LMWA. But on the flood maps, you're going to see the LMWA, the limit of moderate wave action. What they basically found is that the wave height from 1.5 foot to 3 foot actually was causing a bunch of damage, both from research as well as real life going out in the field and seeing post-storm. So from the edge of the VE zone to this line, this LMWA, is now the coastal A zone. And they encourage communities to build to the VE zone. And there's some CRS credits and stuff you can get. But I put it in here from an insurance perspective is there aren't any difference in rates. They're the same. But if they do build to a VE, they might get cheaper flood insurance costs if they build to the VE standard in that area. And as you'll hear me mention is risk rating 2.0 is coming, so that may change as well. I don't have any more details on it, but just FYI that this coastal A does not have different rates. It's shown on the limb wall. So the limb wall is shown on the flood maps. You've probably seen it there. As I mentioned to you about the community rating system. The other thing to think about is COBRAs. The COBRAs has been around for a while, almost 40 years. Basically, it's the Coastal Barrier Resource Act created the Coastal Barrier Resource System, and then later otherwise protected areas. In those areas, they want to discourage building, and so therefore most federal funding and financial assistance is not allowed in COBRA systems, COBRA areas, and that includes flood insurance. Now, if a private policy wants to be written there, if a local community allows you to build there, okay, but there's not going to be federal funding there. FEMA does not maintain the maps. U.S. Fish and Wildlife Service does. They used to be put on the paper firms. They no longer are. And starting last year, they started bringing in a layer of the COBRAs from the Fish and Wildlife Service, so it would be up to date because the Fish and Wildlife Service has been now updating through their map modernization those lines. So they are available, but I just warn you, if you look at a new paper map and you don't see them there, it doesn't mean they're not there. And that can be misleading for insurance agents, unfortunately. A couple other coastal considerations. Vacation homes on the coast or even on the lake or the river, secondary homes do not qualify for a replacement cost, only cash value. So they need to keep that in mind. And secondary homes that are pre-firm, built before your community's first map, are going up 25% a year until they reach full risk rate. So those vacation homes can be kind of expensive for sure. So now we come to the big poll question. It kind of combines everything together. So I'll let you read that while I pull up the new polling question. And the new polling question, because this question is so long, is kind of shortened. So definitely read what's on the screen before you. All right, let's see if I can get it up there. Hopefully you see it up there. And I'm going to read this to you and with some emphasis. So a community joins the NFIP in September 1st, 1983. What a great day, my birthday. A house in that community is built in 1984 and it's built in 1984 and located in Zone X. Sadly, the owner did buy flood insurance as his lender didn't require. Well, in January 2019, a new flood map became effective and the house is now in Zone AE. The owner still didn't buy flood insurance. However, 16 months later, actually it wouldn't be this month, but let's say it was, the lender requests evidence of coverage. Check which rating option could be used, if any. Notice the highlight of the S. So is it pre or post firm? When did the map change? What happened in that map change? So now 16 months later, what rating options could be used? Newly mapped procedure, grandfathering, conversion, or no option. And I will tell you, again, for CE credits, even if you're not sure, we do need you to record an answer. Again, joined in 83. The house was built in 84. Didn't have flood insurance. New maps became effective last January. Now, actually not 16 months, whatever it is, 21 months later, the lender suddenly woke up and said, oh my gosh, we're supposed to be requiring flood insurance. So to do that, which rating option could be used, if any? And while I'm doing that, I'm going to sip some water. I see, looks like one or two might be left. Put on the Jeopardy song. All right, I'm going to close out the poll in 5 seconds. So if you could get your answers in, 4, 3, 2, and 1. All right. Let's show the poll results. And what we're showing is a lot of people put in the newly mapped procedure, a few grandfathering, a few no option conversions. So let me start at the bottom. So no option. Well, there is an option. So that's a good thing. Conversion. Remember, conversion is going from a high risk to a low risk. So conversion is not it. Grandfathering. Grandfathering is where you lock in that lower risk zone to use for future rating. So it was in Zone X, gone to Zone AE. It is post-firm, so by using built-in compliance, you could show that it was built in Zone X as a post-firm house. So therefore, grandfathering could work, but it would automatically start at a standard Zone X rate, that $2,200 in the example I gave you. The best answer option for the agent hopefully would give is the newly mapped procedure. Yes, it's after the 12-month window, but because a lender required it at 16 or 19 months, then they can still use that and still start at the newly mapped procedure, the PRP, and slowly go up over time. So the best answer would be the newly mapped procedure. So great. And we're going to save the results so we have them for CEC stuff, and let's move on. So that was my last poll question. Again, with CECs, we're going to have to wait till the end to get all the rest of the information. But let me ask Emily if there's any questions in the chat. I think we've got some time to take some. Yeah.
We don't have any questions currently in the chat, but I think we can scroll on forward and we've got a couple more opportunities for folks if they want to enter in a question in the chat box.
Great. Yeah, definitely feel free to, as you get those questions, you mind put them up. As I mentioned, if I'm not sure of the answer, we'll definitely get back to you. So sometimes the changes that the NFIP is putting in, a lot of it due to the legislation passed by Congress, pushes up the premium and people get concerned and raise issues. And it happens to be right around the time a map change happens. Even if it was a preliminary map, they'll start blaming the maps. I've seen it too many times. So I want to just highlight some of the recent changes to the NFIP flood insurance program. So I'm not going to go over all the history, whatever, but jump straight to it. Let's talk about the premium increase caps. It was 10%. Now it's 15% on average for a rate class. So for those of you that ever seen a rate table in the NFIP manual, that table on average can't go up more than 15%. But any one rate can go up 18%, but that means another rate will have to go up like 12% or whatever. So it balances out no more than 15%. However, as mentioned, Congress identified certain types of rates that need to go towards full risk rates, actuarial rates, as soon as they can. And so they've developed where certain structures pre-firm will go up 25% a year. And the first one happened January 2013. So it's been moving up there, more than doubled premiums over time for those, 25% a year. So which ones are those? So let's take a look at pre-firm homes in zone A and V and D. So preliminary residence, those rates, primary residence, those rates are not affected by this. They'll go up on average 15 to 18%. They have to go up at least 5%, Congress said, but 15 to 8%. What is affected are those vacation homes, those rental homes that are out there. They're not the primary, they're the secondary residences. They will increase 25% a year until they reach full risk rates. So think about that. And I emphasize when you're talking to realtors, because sometimes they may be selling a home that's a primary resident, and the person is going to use it as a vacation home, and they're suddenly wondering why the premium for flood insurance jumped up dramatically. Wasn't a MAP change, wasn't a bad re-rating. It's how it's being used. Pre-firm buildings, other pre-firm buildings, the ones most is the bottom one, the businesses, the commercial, they are going up 25% a year until they reach full risk rate. Also repetitively flooded or substantially damaged buildings as well. Some assessment and surcharges. The reserve fund assessment they put in because they said stop borrowing from the Treasury all the time. First, why don't you set up a reserve fund like real insurance companies do and take from that, and then if you go through that, borrow from the Treasury up to whatever limit Congress gives you. So they just bumped it from 15 to 18% this year. And then, as we all know, the HFIA surcharge, Homeowner Flood Insurance Affordability Act surcharge, $250 surcharge on all policies except for primary residences, which is 25, and it's on all policies until the pre-firm subsidies go away. And that may be your grandchildren's grandchildren, we don't know, but it'll be there. The good news is that money does go to pay for, goes into the reserve to pay for future claims. So that's a good thing. Lapse subsidized and new MAP policy. So what a lapse policy is one that does not renew. And this is important to know and communicate to your constituents out there, policyholders. If they don't renew it, and it lapses for more than 90 days, they will lose out pre-firm rating, and if it's newly mapped, they will lose out the newly mapped procedure, and also grandfather. They'll lose that out as well. Or if they keep forgetting to pay it, and it lapses more than 30 days twice, the same thing will happen. The exception is if they no longer have a loan or the community is suspended. So hopefully in Georgia, no communities will be suspended. But what you don't see in there is the oops, my lender forgot to pay it. That's not in there, and that happens. And therefore, it's incumbent upon the property owner to make sure it does get paid at renewal, or they're going to lose it. It could be a costly mistake. And if the insurance agent doesn't work on it, it could be a costly mistake to them. So what have the rate changes been? You'll notice they decreased, and now they've been slowly increasing the average there. If you break down the April changes, you'll see that still the post-firm, the full risk rates, the actuarial rates aren't really going up that much compared to the pre-firm rates. But one that really is going to change this year is the preferred risk policy is going to go up 15%. We just keep getting hit more and more. Those storms are being bigger and more active and spreading outside that 1% annual chance, and we're getting bigger storms. We're hitting areas that are mapped as a BC or X. So those rates are going up. Other changes, a couple years ago, you could prorate refund the FIA. Used to FEMA held on to that whole 250, but now they're going to prorate that. You now can have two primary residences. How? Well, somebody, I always use the example, the couple that lives in New York and has a house in Florida, and she loves Florida, he loves New York. They both live there more than 50% a year at each location. Therefore, they can show they have two primary residences. And I guess their marriage works okay. October 2008, that's when that additional 12-month was extended on the newly mapped procedure eligibility. From 12 months to 24, but only if it's lender required. 2 to 4 family building can actually be a primary residence. How can that be? Because one of those units is actually the building owner. So that's very significant, especially from the FIA surcharge perspective. October 2019, some minor changes were made to mostly for the coastal areas to be aware of. And in this, it passed. There weren't that many changes. V-zone factor rate, nobody was using that factor form, so they got rid of that. Any of you that deal with non-residential commercial flood proofing, how they rate, the forms they use, all have been changed. So definitely take a look at those changes so you understand what they are. Finally, speaking of changes, next April 1st, we're going to see the risk rating 2.0 revealed. They're going to provide a whole new rating system, makes it easy for agents and policyholders, as well as you guys, to explain what the risk is and how the rate really reflects the risk better. It'll be more specific to the property owner's property and not a big general area. They'll include more types of flood risk like fluvial in it. As I mentioned, April 1st, the rates will be released, and then they'll become effective October 1st, which means the renewal notices will be going out like in August. So just know that's happening. If you want to know more, they do have a web page that you can go to stay up to date on that. And that's about all I'm going to touch on Risk Rating 2.0. With that, before we jump into the resources, want to just check to see if any other questions popped up between M.A.P changes and NFIP changes, Emily?
Yes, we do have a question.
Okay.
3 years after M.A.P changes from X zone to an AE zone, how hard and how does the new owner obtain best rate when below the new base flood elevation?
Can you read that one more time because you broke up at the beginning? Sorry.
Okay. 3 years after M.A.P changes from X to AE, how hard and how does the new owner obtain best rate when below the new BFE?
So if it's a post-firm building, you can go back and have it rated as Zone X using the standard Zone X rates. So you don't need that elevation certificate. You just have to have evidence show where what the flood map was and work with the agent in getting that detail with the flood map. If it's pre-firm, they missed the opportunity for grandfathering rating, and they'll be rated as a pre-firm building using Zone A, but being pre-firm, elevation certificate is not needed in that case. Again, the newly mapped procedure doesn't apply because it's past the 12-month period or even the 12-month that the lender, if a lender happened to be requiring it.
All right, we've got one.
Okay.
With the policy rate increasing, why can't preferred risk policies get CRS discounts outside of the special flood hazard area?
Again, you broke up. Why don't they or why do they?
Why don't they?
Because even though they are going up in 15%, they still are going to be cheaper than a standard Zone X rate. So FEMA's opinion is we've already discounted them a lot. We're not going to apply the discount any further. So I've not done a standard Zone X, but if you take the example that I had of a standard Zone X rate was 22, our premium was 2,200, and you take the maximum Zone X, it's 10%, so that brings it down to 2,000. That's still, and then the PRP equivalent was 450. That is really discounted a lot compared to the 2,200. So FEMA said we don't need to apply any more discount on that PRP.
All right, great. Thank you.
All right. Well, we're coming down to the finish line. I just have some stuff on resources. And so let me go through those for you, resources and tools. Hopefully you all are familiar with this, the Flood Map Service Center. You can get, of course, the current maps, the preliminary flood maps. You can go back and get historic maps for grandfathering if you need to. And you could go on the National Flood Hazard Layer and get look up the property and get ferments there, or on very old maps, you can get the old ferments. I mentioned that the U.S. Fish and Wildlife Service works with, now it handles all the mapping, or has always handled the mapping of the COBRA zones. They've got the links there. They've got some great tools, and if you haven't looked at them, take a look at them, use them. They can pop up a report for you like this that you can put the pin in of where the property is and gives you the explanation. Insurance agents can use it about the COBRA documentation related to that property. Very useful. Highly recommend using that. But the number one flood zone, number one website to go to, of course, is georgiadfirm.com. A lot of great information there for you as community officials, as well as property owners can look up their risk. Up there at the top, you can get the flood risk report, which, you know, I work a lot, as many of you know, across the U.S., and I think this is one of the best flood risk reports that an individual property owner can get. It's visual. It talks to in pictures as well as in words, communicate what that flood risk is. I'll talk about the outreach toolkit and videos, but they're there as well. If you do not have these bookmarked, bookmark floodsmart.gov. That is the consumer site. FEMA is constantly updating that. Some great resources there. If you want to get more into the manuals and underwriting, you use this website, and from there you download what I call the NFIP manual, Bible, which is the manual. There is the new URL for that. This is what they refer to, and I highly recommend you to go towards that. Another resource from an insurance perspective is agentsfloodsmart.gov. You say, like, well, that's for agents, but no. Lots of great resources and marketing information that you can use, Twitter, Facebook, etc. But the mapping toolkit right there, that page walks through. See those little dials? Walks through exactly what I just did for you in the past 30, 40 minutes there. So use that. They've got great material. And while you're there, download the cost of flooding tool. You can, I don't know if you can see my cursor, but you move this little guy up and down, and this number changes for how many inches of flooding in your room. And you can pick the size of the house as well. What a great conversation starter for someone to say, well, I think now a couple inches won't harm. Well, let me show you. How big's your house? But that, did you know, where are you going to get $52,000 of just 6 inches of water? You think 6 inches, that's not a whole lot. Yeah, but look at 52. So you're going to have to get your college kids education fund or your retirement fund to pay for this, or get a PRP for $450 or $300. They start at less than $300 right now. I'm going to have to start saying $350. But anyway, great site for you. I've got here those little links at the bottom, those little worlds with the marker on it. Those are the new URLs. Even though it's for agents, these also are very good for you to understand what the different map changes are. And this, I like this last one on the right, tips. It tells you what you should know. It says the agent, but so take the word client or customer out and put in property owner, and what you should say helps you talk about each of those. And then if you want something up on your website, I was going to say in your office, if they ever start coming back to our offices, here are some for property owners for you as well. But when you're going through map changes and communicate flood risk, the GeorgiaDFirm.com has this flood map outreach planning guidebook for local governments for you. It's got templated material, as you see there, everything in red you put in to customize for your community. Otherwise, all the writing's done for you. It's all there. Now, if you don't like something that's in there, take it out. We want you to make it customizable for you, but it takes you through the different mapping life cycles, what outreach you can do, and then it gives you the material as well. All there on GeorgiaDFirm.com. And with that, I think we've got a few minutes left. Yep. And let me see if we have any questions. So let me remind you that for 1 hour CFMCEs, type your name and email address in that chat box. And we've got some resources on the right-hand side. Hayden is the manager of the floodplain unit, or NFIP state coordinator. Of course, Emily, who's moderating this here. And then the insurance expert, Dwana Davis, FEMA Region 4 insurance specialist. She knows so much about the flood insurance program. She's a great resource for you as well. So with that, Emily, I'll hush up for a second and see if we have any questions while people put their names in the chat box.
We do. Let me reiterate one thing real quick, because we do have a few folks going ahead and putting in their name and that they're looking for CFM credits. Be sure to include your email address. We do have a question. Looking back at a previous slide showing a B zone, coastal A, LIMWA, and X zones, is the coastal A the same as LIMWA?
Well, a LIMWA is actually just a line. So a LIMWA is the line where you go from a zone V, which is defined by a 3.5-foot wave, to a 1-foot wave. So a 1.5-foot wave. So that area in between that is the coastal A, but the LIMWA, I know sometimes people think LIMWA is an area. The LIMWA is just a line where the moderate wave action stops, and the rest of that then just becomes a zone AE.
Okay. And how do you feel about the realtor.com website for flood information?
So I am open to anything that helps properly, if you will, helps people look and try to understand what their flood risk is. And I know there's some people in areas, and I don't live in in Georgia, but actually a little further west in Arizona. And actually, Maricopa County is talking with the people who, with First Street Foundation, who put together the database behind the Realtor.com, or I should say that Realtor.com is using. And in some cases, it matches up well, and in some cases, it shows it higher, in some cases, lower. But what it's doing is it's starting the conversation. It's giving the opportunity for someone to go in and easily look at the maps, or look at a way to determine what their flood risk is. We all know that the FEMA maps are great from a regulatory. They're probably the best, the gold standard we have right now. But if there are ways that they can take some of the flood risk information that FEMA has and incorporate it into their model to make it even that much easier and better, I think it's helpful. But again, from a regulatory basis, from an insurance basis, we're still going to be using the flood maps for sure.
Great. Thank you, Bruce, for that very informative webinar. We'll keep the chat open for a few more minutes so you can still submit questions. Please be sure to add your email address along with the question so we can follow up with you. Again, we're offering one continuing education credit for today's session available to the CFM that completed the polling questions and provide us their name and email address at the end. We will be distributing the slide deck and a survey that we greatly appreciate you completing. If you requested continuing education credits, those certificates will be emailed separately. Finally, and since somebody asked this, I want to make sure you hear this. Finally, mark November 4th on your calendar for the next Lunch and Learn, where we will have David Arkins from ISO here to talk about the significant changes happening to the CRS program in 2020. Thank you so much for attending today's event. And for those who have any questions, this is the end of our Lunch and Learn webinar. Have a great day, everyone.
Right. Thanks, Emily. Thanks, everybody, for attending. So, Tom, the LIMWA is just a line. It's the limit of moderate wave action. So it's the extent. So the actual coastal A, I don't know if you can see my marker, is from where the V zone is, marked by the 3-foot wave height, to where they show the wave height gets down to 1.5. That's the coastal A. But to show where that 1.5 stops, that is the LIMWA itself. Limit of moderate wave action. So it's just a line on the map. See if I can make it go. This black line right here. So hopefully that helps. If not, you and I can get offline and talk about it. All right, well, I'm going to turn things off. And thank you, anybody else who's listening on. Appreciate it, and look forward to seeing you all November 4th.